Paul, the presentation we had a quick peek at yesterday looks fantastic, so I'll let you deep dive into it. My understanding is it's shy of 30 minutes or so.
Yep.
So, if you want to open it up to questions during, sort of flag it for people, but otherwise, let's keep it to the end. Go ahead.
Yeah, sounds great. I'll start the timer and we'll get into things. I mean, the point of this, what I call a dialogue, is just to get some questions brewing. Yeah, throw them down in the chat. If something's like ridiculously unclear, then yeah, jump in, Michael, maybe, and then yeah, I'm sure we'll have a good rapid fire at the end and ongoing, right? I mean, things change all the time, and for those kind of here who have worked with startups or been in a startup or are in a startup, buying a place is just like a startup. You're iterating it, you're tweaking it, you're planning it. Yeah, and it's always changing. So I always say it's about trade-offs and running numbers. And hopefully today will kind of remind you about some things and also get your mind thinking a different way on how to be entrepreneurial. Whether, of course, you're like looking to buy a spot, whether it's an investment property, which is probably the main use case here, and or just even a refinance, right? What are the best ways to approach that? So yeah, excited. Guess have my kickoff prezzo with the squad, and yeah, let's roll into it. Trade-offs. It never seems to be perfect as far as low home prices and low rates. So as a lot of you have probably heard, rates are going up. March the 2nd, they went up 0.25. And yeah, in April, so Bank of Canada meets 8 times a year. The next one's in April. The next one may be another 0.25, maybe 0.5. They're saying by the end of 2023, it'll go up, 1.5 to 2%. And once we talk about fixed versus variable, you'll see the delta between the difference, and you can start to sort of, we can talk a bit about the numbers, and you can start to make some even rough calculations on whether you should make a move now. But I mean, look, in general, you know, I wish Brad was on here, but he'll attest that a lot of his teammates their clients are winning offers. That's because there's less competition on properties. Now remember, variable rates going up, even fixed rates going up, that has not affected people's affordability per se. Usually you qualify off the stress test, which is 5.25. Rates are nowhere close to that. Now, of course, if you're looking at an alternative lender, their qualification has changed, and that's more of a technical thing to review another day. But this is really because people, I think, are just more so just exhausted, and with the rates going up, the ones who weren't that serious are just parking it. So, in general, if you're in professional services, I think it's separating people that are serious to those who are not, and I think it's generally a good thing. Now, as rates keep going up, obviously that's probably going to slow things down. So, this is kind of the time to, understand who's really sort of serious. So, yeah, just like, quick agenda. I'll walk through a bit of a story of what I see very regularly as far as use cases and, how people are sometimes just kind of being led down the wrong path. The velocity of rates, and then just how to position your finances right. And we'll talk about different kind of use cases and stories. And then, of course, Q&A. There's a massive appendix. I could perhaps flip to if any of these categories make sense or, perk your ears. So just first a quick story. I had a client not too long ago that I guess when you're overwhelmed and you're emotional about things, you go for the path of least resistance. And that is just kind of that's how we're primed as human beings. And path of least resistance is you go to your bank for a pre-approval, and you go with your friend's realtor, which a lot of time will be fine. But I think with this kind of market, it just as like and everyone here is an entrepreneur, right? To some degree, you gotta weigh out options, and I think there's a line between shopping around the 50 lenders yourself and wasting a bunch of time, and maybe looking at a couple different sources. So I see a lot of especially first time buyers who actually don't have like a solid team as far as their financial advisor, mortgage professional, realtor. They go to lowest hanging fruit, and then of course, especially when you go to a bank. So again, they have to stress test you, right? So usually credit unions do not, neither do certain alternative lenders, and that can be a swing of $200,000 to $300,000 in mortgage affordability. I'll say that again. $200,000 to $300,000 of mortgage affordability can be the difference between a bank and a credit union, which, by the way, have basically the same rates, right? So yeah, I think people really got to have a plan A, B, and C with when they get pre-approved, and not so much just off one lender. Um, Something unfortunate with this kind of, I guess, couple is that they didn't really get any budgeting presented for them. Like they didn't like ask about the numbers. They assumed that the best case would happen, that their pre-approval, which was just enough for the condo they wanted, would work. Of course, they were in multiples. Of course, there was, a red flag where one of their credit scores, like one of them was just new to Canada. So even if you have a great credit score, right, let's say anywhere above 680, like 800, but you haven't really used a lot of credit. So, i.e., you have thin credit. Lenders will see that as a red flag and sometimes ask for, well, or let's see some cell phone bills that you've paid. Let's see some other things. And they didn't have any of that. So they could not use any of her income. She made 80K, which you'll see in a moment how much that messed up their affordability. But suffice to say, not being able to look at a lender that will be more generous with thin credit and or a lender who does not stress test them, they could not buy anything. So now we're working with them, and we're working on some things, but since the last time they started looking when prices were 15% less and rates were as low as 1.2. So there's an opportunity cost to everything. And at this point, really, like waiting, it's only going to get more expensive, especially on the rate side. Brad will speak more to this, but I see property prices cooling off, but they're still going up. So every day you wait, especially if you're a renter, I mean, you're paying rent and you're paying more tomorrow. Um, that's the general thesis on it. But again, like, if you're not ready to go, then don't do it, right? This isn't like rush. It's like, if you're thinking about it, like, this is the time to like have an honest conversation with yourself. Yeah, quick intro. I guess I know a handful of people here, but I guess I am fairly new. So, I mean, my background, I've been building tech and marketing companies for basically a decade. And every business I've run, really, it just comes down to what are the numbers and what are the trade-offs. I feel like this industry, like just kind of getting into my marketing agency, and we had some customers in the realtor and mortgage niche, and we just saw how underserved it was, not just as far as them, being able to market themselves properly, but also just like the general public not really being walked through the trade-offs and the numbers in a way that they should. It's very much like going to the supermarket. Do you want a fixed or variable, 3 or 5 year term? Okay, cool. See you in 5 years. And it's just like, I think it's just such a miss to go to a bank and get a mortgage. It's the same half-ass way you might get it, like a line of credit or a new credit card. Like, just get her done, right? But you'll see later on all the different layers of a mortgage that not only, of course, can save you money, but it can even help you, be a savvier investor, get tax write-offs, do the right kind of refinancing. And, this is the first domino that's going to affect your second and third property, assuming you want to, buy some investment property. So you got to have that 2020 vision, looking forward actually, versus just looking backwards. But yeah, I work a lot with like tech companies. So I did a lunch and learn at Amazon just on Friday. A lot of investors, of course, first time buyers, lots of entrepreneurs, especially, who, like, you write off your income, and lenders usually are going to look at your 2 year average on your T1s. They're not going to look at your cash flow unless, of course, you go to a different kind of lender. So more on that later on. In background with me, born in Mexico City, grew up in Vancouver, currently in Toronto, and well, at this moment, kind of doing some remote work in Austin, Texas, but we'll be back in Canada very, very soon as the spring kind of comes up. So anyways, yeah, and I guess with us, we were lucky enough to get nominated for Broker of the Year last year. And, I'm surprised how little strategy a lot of banks and some brokers do. So I'm really trying to like level up the industry just to kind of, and have people ask the right questions, and understand there are some pretty big blind spots that are not hard to uncover as long as you're curious enough. um, Mortgage market dynamics. So yeah, raising rates, that's definitely a thing. And that's, of course, because of inflation for a large part. Low fixed rates are now in the low 3%. You're going to see variables are the high 1%. Uh, as I mentioned earlier, variable rates are looking to go up 1 to 2%. So in the next slides, you'll see kind of what's the trade-off between fixed and variable. One bright spot I'm seeing on the mortgage side is that there are a lot more home equity line of credits, so HELOCs. TD just introduced one, and there's a lot of cool little cashback promotions. They're not something you should make a decision on. Like that shouldn't be your swing factor, but you should ask about them because this is when lenders tend to do that. So again, if you're refinancing or buying a spot, it's good to count up all your ducks and make sure you're getting the full value. And then, yeah, in general, there are a lot of mortgage lenders that are on the rise. Some of them are prime best rate lenders. Like if you've heard of MCAP or First National, they will have lower rates and lower breakage penalties than most banks, especially on the fixed side. And yeah, I don't know. Some of them are more on the alternative side, and they're the ones who'll be more forgiving on, credit that's not where it should be. If you've written off income, they'll be more forgiving around that. They'll let you afford, usually a lot more, and some of them do like 40-year amortizations. If you want to lower your payments and afford more, there's some pretty cool stuff they do. And again, those will be covered a little bit later on. So mortgage planning, gonna walk through a story here, something that, I think it's gonna get your brain going. And number one, it's fixed or variable rate. So you'll see in the chart, most people do fixed. Some do variable. And the funny thing is that, well, variable historically beats fixed. So why is there almost more than double people going with fixed? I really think it's just completely psychological. Also you go to a bank, it's an easy sell. Fixed, the rate doesn't change. End of discussion, right? They're volume vendors. They don't have time to explain things, usually. And you'll see very shortly that there are some trade-offs with fixed, especially on the side of breaking your mortgage. So let's get into it. So the fixed rate, for those of you watching the Bank of Canada bond yield, they follow that basically. And it really depends what kind of person you are and your risk tolerance and like what helps you go to sleep at night. Really, it's a personal thing. But yeah, pros is that you should do a 5-year term. Not to be confused if your lifetime of your mortgage, but every 5 years you can renew or switch somewhere else. Most people switch because lenders want your money, and a competitor will generally, they usually will beat the current lender on the renewal. Not always though. If rates go up as they are now, you stay locked in, and that's where, in some ways it might be wise to be fixed, especially if there's no variability in your life. And I say this if you're with a growing family or not even married yet, and there's chances of you switching jobs, you're looking to perhaps buy another property, you might have to sell this one. You don't know if you can keep both of them. When there's a lot of variability, fixes can be tough because, like I had a client who, she makes 7 figures, right? Like, big CFO and obviously busy. So she didn't see that there's higher breakage penalties on fixed, so she didn't know how much it was. She only had $1 million mortgage, right? But she actually was threatened with $129,000 breakage penalty, right? So $129,000 from her bank for switching. She was at a 3% at the time, a fixed 3%, which isn't bad. Especially with today fixed are around 3%, but she wanted to go to a 1.2 variable. This is about a year and a half ago, so it would have been a huge cost saving. She couldn't move. She was pissed. Anyways, you got to understand that, with fixed, there's a huge breakage penalty. And the math is called the interest rate differential, more complicated formula, but basically it's what was the rate you got before, have the rates gone up or down, right? Did you get a big discount and how long is left? And then usually it's about 2 to 4% of your actual mortgage balance. That's how much you can look at for you break it with a bank. If you break it with a non-bank lender like MCAP or First National or Lendwise, they're usually a little bit less. They're about half of what the banks are. So if you want to go fix, I recommend going with a non-bank lender. And yeah, like as I said, if you want to switch lenders, that's usually breaking your penalties. So a lot of people saw way better rates and they couldn't switch. So they wanted to refinance to do renovations. Much harder if your lender doesn't have a line of credit component. So again, all things that are important to think about before you sign the dotted line. Variable rates. So they only move off the overnight lending rate, which influences, of course, the prime rate. So if you have a line of credit secured against your house, those are usually prime or prime plus 0.2. So right now, prime is 2.7, and again, that changed super recently. And like, take a look at the pros. So the delta right now, I'm seeing as low as 1.75. And these are from like decent lenders. Some lenders like HSBC have like 1.25, but they work with Mexican drug cartels, and they're very hard to get a hold of. So like everything's a trade-off on not just your morals, but I think just in general, like customer service and how stressed you want to be, right? Like it's like buying a cheap car. There's going to be things battles you gotta fight, and those are all things that ask your local broker around what those are. But 175 and 3, 1.25 difference. That's going to be closing, obviously, by how much to be determined. Um, the best part about a variable, even if variable like surpasses fixed in the future, is that you have flexibility. Like if you break your mortgage, even with a bank on a variable, it's 3 months worth of interest. You remember you've got your monthly mortgage payments, about a third of them go towards interest, 2/3 go to principal, generally speaking. So, 1/3 times three, we're talking, not a lot, about 1,800, maybe $3,000. And, small price to pay if you need to do a big move, like sell for a bigger place. And you can port your mortgage, and there's ways to not exactly break your mortgage, but you're stuck to the same lender, which may not have the best rates, and you always have to sometimes blend into the current market rates. It can't just transfer your low rate to a higher rate. There's a blend. Anyways, just off the fact that you can do whatever you want, like that lady who made the seven figures, she could have easily switched, paid $3,000, and she was going to save like $900 per month. So she would have covered that in 3 months. So, anyways, right? Flexibility is huge. And yeah, obviously there's a big kind of rate savings right now. And just some like quick numbers. They say for every $100,000 that is on your current mortgage, when the rate goes up by 0.25, which is generally speaking how much it goes up by, when the Bank of Canada announces where things are going, it might go up 0.5. So you just have to double this number here if it goes up by 0.5. But someone who had a $500,000 mortgage before March the 2nd, so $13 per 100,000 that you borrow is the number, right? So $13 per 100,000 on your mortgage. So in this case, 5 times 13, 65. So to pay $65 more per month based off an interest rate rise, I mean, it's not nothing, but it's probably less than you thought, right? So again, I think variables can be scary until you run the numbers. It might make more sense. I should say that some lenders like TD, and by the way, love banks. We work with a handful of them, right? They have a thing where even if variable rates go up, your monthly mortgage stays the same, which makes you think, what's the catch? Well, they have a thing where basically instead of it going up by X amount as far as your budget, you pay $65 less on the principal and $65 more on the interest. So really, you're just kind of extending it in a way. But anyway, so there's lots of cool stuff there. Andrea, she's going to be our fictional character. Moved to Vancouver recently from Mexico on probationary period. She's a PMP but has no PR. So she makes 120 plus bonus, hasn't used a lot of Canadian credit, wants to buy $1 million home. It is something that she can pull off. So number one things I would have her think about is, well, if you're on a probationary period, generally speaking, you want to be past that before you start even making offers on a house. Of course, of this market, a lot of people make the calculated risk of, okay, I'm still going to go look at places and even make an offer, and I'm really sure I'm not going to be kicked out of my job because, usually they've got their reasons. So, but I'm just going to make sure that my closing date when I move in is at least 10 business days after my probationary period is over, i.e. that 90-day period. So I see that happen a lot. You got to make that calculated risk, but generally I see it as being fairly safe. Makes 120K plus a bonus. She cannot use the bonus income unless she's been having it for 2 years straight. And this is kind of like the rule for entrepreneurs. Banks don't believe that you are going to keep your income consistent. they want to see the last 2 years. So right now they're looking at 2020 and 2021 if you filed that. Now, if you haven't filed 2021 now, and let's say 2021 was a bad year, you probably want to do this ASAP. So look at 2019 and 2020, right? So little tricks you can play around with there. And again, they'll look at your T1 average, right? So if you write off income, there's obviously limitations there. Yeah, and if you haven't used a lot of Canadian credit, we'll talk about in the next slide how to change that, or even if you don't have the best score, there's easy ways to repair. So you only get to $1 million, right? So here's an easy formula. If you want to know how much you can afford on a home, right? It's your down payment plus your mortgage maximum equals your home value, right? So let's solve for DP, or down payment. So there's a sliding scale. There's a myth or rumor that, oh, if you're a first-time buyer, you can do 5%. First-time buyers and the 5% have nothing to do with each other. So you can be anyone. You can do as low as 5% up until $500,000. After that, there's a sliding scale. And then the big jump is you have to do minimum 20% at $1 million property. And or if it's an investment property, then they want 20%. A lot of people are getting gifts because, man, it's hard to be liquid these days, right? Hard to put down that amount of cash. So if you have clients that are from out of town, they got to have their money in for 30 days. There's a lot of anti-money laundering legislation. In general, if you're just you see someone local getting a gift, it has to be a direct family member. Friends aren't allowed. They're very picky on down payment, where it comes from. So, make life easy for yourself and just plan ahead. And then, of course, there's closing costs, generally property transfer tax to budget as you're, closing in on a place, right? So don't forget about that. And so the foreign buyer's tax, by the way, it applies if you have a work permit, not on PR, not on citizenship, but even some people who have a work permit but are PMP nominates, that's a place where it doesn't apply. I should say that it also doesn't apply like in Kamloops or certain kind of out there areas, even if you have a work permit. So just make sure you understand the geography applications for it, and also PMPs do get an exemption. So credit score, really quickly, just aim to have above 680, generally speaking. If someone has a thin credit score or not the best credit score, there's a 222 rule. They just say have at least 2 lines of credit or credit cards with $2K of limits at least. And if you're using it for at least 2 years, that's when you've got like the golden kind of formula there. If you don't have that, again, some lenders they just want to see, like, are you good at taking on credit? So like, okay, well, let's see if you paid your rent, show some rental payment history. Let's see how good you are at paying other bills, right? So little things to have back of pocket, perhaps to advise to a client who's international. We're getting 400,000, immigrants a year at this point coming in. So this is really relevant for those kind of people. Some big do not. It's like, don't close your credit cards. It might seem like it's going to help your credit score, but actually that's your paper trail. It's your resume of taking on credit and hopefully not, being late on payments. So people's scores have gone down by up to 100 by closing your credit cards. Car loans before are not a good call, because you'll see very quickly that it is a debt to income ratio. The more debt you have, the lower that you can afford. And just, by the way, pre-approvals for clients, I say get a pre-approval. It does hold you a rate, which is reassuring, but more importantly, it helps you just understand where you're at and what your options are, and you're doing strategy now versus doing strategy when you have a live offer and you're stressed and you go with the easiest option. No, like, do your strategy now, because it's all about decisiveness here, right? If you're not decisive and you're scrambling and there's certain paperwork you realize it takes, maybe CRA has to mail to you, and you're scrambling at the end, it's just like, it's so unnecessary. So you can get pre-approved, takes 2 seconds, and you can get a rate held, which I think is affordable and important. So rule of thumb on affordability, broad strokes, if Andrea makes 120K gross salary, this is of course before taxes, you times it by 5. That's generally how much mortgage she can have and how much mortgage you can have. It's 5 times your income, or people, of course, the income on the application, which is the household income. Now, if Andrea has a car loan of $400 a month, or she owes 13K on her credit card, and again, the easy kind of rule of thumb, broad strokes, is you can subtract 100,000 for every $400 a month or 13,000 of outstanding debt. So in this case, her limit goes from 600,000 to 500,000. Now, this is on a 25-year amortization. If you have a 30-year amortization, that can be more like six-ish, the multiple. If you're doing 40-year amortizations, you're not getting stress tested, that's more of a 7, 8 multiple of your income. So again, there's ways to stretch your mortgage. You should investigate and see what plan A and B are. But yeah, she wants to go for $1 million. She's got 200,000 down payment, 500 mortgage max. She cannot afford that. So how do you stretch mortgage, right? Obviously an important thing with the way home prices are going now and the competition, which is still there. So co-signer options, she doesn't have that option. But yeah, if you have a co-signer who makes income, and hopefully that income is not offset by some of their current debt, whether it be an existing mortgage they have, car loans, then generally it can help you on that 5 times their income multiple. But again, you kind of got to know their debts, and if they're, if it's like a parent and they have a pension, but they've got a big mortgage still, probably won't add a lot of value to the application. Rental income is the big one, which in this case Andrea cannot use. But like, I mean, yeah, like I think we had a question last week around like refinancing and things like that. Especially if you have a single family home, even if you don't rent out your basement, you can get a market rent appraisal, and obviously a mortgage helper is which shows how much potential income you can make on your rent. That's going to help you quite a bit. Now the thing is, some banks and certain lenders, they only take half of your rental income. Some of them take 90%. There's also a formula. Is it an add back or an offset, which is nerd talk, but basically, put it this way, they make a difference. So to stretch, rental income is important. Projected rental income. If you already have a tenant, but you don't claim rental on your T1s, a lot of lenders won't count it. So by the way, you should claim as much of that as possible, especially if you think you might want to stretch mortgage for your next place. Net worth programs are available. Generally, it's net of the down payment and closing costs for your next property, what's left in the bank. If you over 250K left, that's a good start to be able to afford a lot more, even if your income doesn't support it. So there's a way to, basically qualify for more off net worth. In this case, Andrea's going to go with another mortgage lender because the other options, as nice as they are, do not apply to her. So the quick scoop on these alternative mortgage lenders, they're all federally regulated, right? And all I mean by alternative in this case, or just mortgage lenders, is that they're just sometimes not the banks, right? So rates can be cheaper than banks, all the way up to 4.5. And again, just thinking of lenders, you've got A, B, and C lenders, i.e. prime, best rate A lenders, which are your TDs and your Scotias, plus your MCAPs, plus your First Nationals, and they're all in the same category, right? Then you've got your alternative B lenders, which they just have a lot more flexibility. And some of them are, again, like 0.5 more than a bank, which if you run the numbers, you'll see that, it's not nothing, but it might be a worthwhile trade-off. They are on the rise because people need them as in-betweens. Like, for example, you have to buy time to just get that raise or pay off that debt, which at this point is inhibiting your mortgage affordability. You may get an alternative lender for a year and then switch out, right? So they're pretty flexible. They know they're not like the desired for people, but they're a great plan B. And if they help you get a property now, what's the trade-off? I'm paying more on your mortgage now, but you're also getting a property that you want at a price that makes sense versus a year from now. How much more is that property going to be worth? And then on that note too, how much more even best rate banks going to be versus you locking in a fix with alternative lenders. So just again, look at your lenders, look at your options. Don't go on autopilot to your bank. Just really be smart about things. But yeah, look, again, banks a lot of times will have better rates, and they'll make special exceptions that more so the prime A lenders that are not banks can do, because banks, they lend off their balance sheet, right? It's their own money. A lot of these guys, like a downside from MCAP, RMG, RFA, these monoline lenders, i.e. prime rate lenders that are not banks, they actually borrow money from the banks. So they're a little stricter in some ways. It's more the B lenders that are way more chill. So banks, again, higher breakage penalties, and by the way, 3/4 of people break their mortgages early. So 3/4 of people are paying ridiculous, breakage penalties because, life happens, right? And it's not always an unfortunate thing. Like you get divorced, it's like, oh, we need another property and we need to sell or we need to refinance, right? Again, on the alternative side, less paperwork, more lenient, lower fixed rate penalties. And I mean, really, it's in this market, you want to have the option to afford a lot more if you need it, right? That's the key. Just to wrap, I mean, it's so important to look at what's under the iceberg. And I think of a mortgage as like, it's kind of like you are an entity, you're a profitable entity, like as a person, but also as your own business. And like you think of like revenue minus cost equal profit. And we talked about like, costs. How do you lower your costs? That's a big lever to being more profitable. And yes, you want to shop for those low rates, but at what expense? Right? And on the revenue side, by the way, there are cashback promotions. You actually get money in your pocket. There are first time buyer subsidies, money in your pocket. But people don't look beyond, people just kind of look at first time buyer benefits and like the lowest rate. But if you look at other under the, surface costs you could incur, again, we talked about breakage penalties. If you really want to repay a mortgage faster, some lenders have more flexibility than others, and therefore you don't have to pay breakage penalties. Some banks actually charge a premium because they know you're not going to bother going somewhere else. And yeah, I think the biggest thing, especially as entrepreneurs, like, look, time is money. Like, how much you value your time? How much you value your stress? Right? If you do get a cheaper rate, again, at HSBC, like, is it worth the stress? Right? Is the person there going to be with you? I don't know, after the next 1 or 2 years. Like, you can probably imagine people turn over at banks more than actual brokers who run their own show, right? So just how much more rebuilding do you want to do with relationships, turnover? I don't know, like just think about the other levers around your future profitability, right? Now, some cool things on the revenue side, ways to actually make more money. If you get longer amortizations, you save more money per month, which you can then invest at a higher yield, assuming you're comfortable with that. I won't talk about it too much today, but the Smith maneuver is like a really cool tax write-off. You can basically borrow to invest, get tax write-offs, and make sure you're still investing in like, conservative, I guess, conservative funds. Like a lot of people think like, yeah, you got to pay off your mortgage, then you invest. Well, the opportunity cost of you not investing now in 25 years is crazy. It could be like $1 million difference because you didn't, you're just focused on paying off your mortgage. I know that's like the way we're programmed. Oh, don't take on credit, pay off your mortgage, but you kind of have to balance it. And anyway, Smith maneuver is a really cool way to start to do both. Yeah, anyways, there's just a lot more stuff that I'm happy to entertain with questions or subsequent conversations. So look at the full picture, do the trade-offs, look at what's below the iceberg, and think of your like what is going to make you profitable, not just today, but in the future. So to recap, yeah, don't be led down the wrong path. Don't be that couple that just doesn't get pre-approved, frantically goes for something, impulsively does it. They're emotional in their decisions. Don't run the numbers. Don't go beyond their local bank, and what do you know? You're priced out. I think there's a closing window of opportunity for low rates, obviously. So now's a good time to at least get pre-approved. If you don't find a place, it's all good. You spent 15 minutes getting pre-approved. There's no cost to it. And I think like with anything, autopilot mode is unadvisable, although your body like is built for heuristics and shortcuts and habits. It's how you conserve mental energy. But here you have to push a bit beyond that. And I think you being here today probably is a testament of that. So yeah, pros and cons on fixed versus variable. Think about, again, like we gave you some rules of thumb on how to, what's your qualification? Again, 5 times your household income is generally how much mortgage you'll get. If you have $400 on a car payment per month, that's going to take away 100,000 of affordability. So minimize your expenses. And then just under the iceberg, right? There's just strategy and so many other costs and potential revenue opportunities that like you can talk to with. I mean, probably a financial advisor. I'm kind of putting on that hat right now, but like just use your team accordingly if you're professionals and like run the numbers, right? That's what it all comes down to. I'll wrap it there. Yeah, hopefully I didn't go too fast. I'm just thinking now, I'm like, might have been too quick, but that's why there's a recording and that's why we'll answer questions. But wanted to make time for a Q&A and just make sure that, yeah, we can kind of dig into your specific problems and use cases. Thanks, guys.